Welcome, ladies and gentlemen, to our Capital Markets Day. I should start by saying that there are no planned fire drills today. So if you hear the alarm, you should leave through the marked fire exits. May I also just remind you that we are broadcasting this presentation live. So with that in mind, can I ask that you please turn off your mobile phones? We have about an hour and a half set aside for the formal presentation today. I'm going to start by giving you an update on the group strategy, and we've structured the rest of the presentation in 4 parts. My colleague Marwan, who's the Chief Executive of Marwan Shadid, who's the Chief Executive of Ecom, will provide an update into our onshore E&C business. Andy Ingalls, Chief Executive of IES, will provide an update on the progress in Integrated Energy Services, IES. I will then return to talk through our offshore EPCI strategy. And finally, Tim will provide an overview of the group's financial profile. After the formal presentation, we'll have the chance for some Q&A. And afterward, we've arranged for an informal reception where you can meet the leaders of all our business units. Well, let me start to remind you what we do as Petrofac. We're basically a service company with a clear focus on the oil and gas sector. We deeply believe that our sector is rich with opportunity but severely capability constrained. Our own development has been characterized by a steady expansion of our capabilities to access new markets and to meet the evolving needs of our customers. As we evolve, we strive for differentiation built on our core strengths. I see 5 key aspects to this. The first is our constant innovation in how we deliver our capability to customers. Whether it is lump sum in EPC, duty holder in operations, or fully integrated solution in IES. They all de-risk project for the customer and align us with them. And when we perform, and actually we perform most of the times very well, it improves the margins we can make for our work. Second, we have a relentless focus on operational excellence. Marwan and Andy will give you examples of some of our initiatives in Ecom and IES in a few minutes. The third major source of differentiation is our focus on local delivery. We deliver with local staff and partners wherever we can to meet our customers' local content requirements, and because it is cost effective. Our training business is core to our strategy and to our capability and is essential differentiator in this regard. It facilitates our entry into new markets and cements long-term relationships with our government and NOC customers. Paul Groves, Managing Director of Training Services, is here today if you would like to take the opportunity to speak to him later on. Fourth, we have an organization that has very effectively managed risk through bidding discipline and hands-on management team, and has protected the shareholder value. And lastly, I believe we have a unique culture which we are carefully sustaining and propagating. It is a culture of responsiveness and delivery, and our customers say that this really makes a difference. These, I believe, are the core elements of our business. They have enabled us to deliver sector-leading performance. Just to go back and look at our performance on a historical basis, and we've done this based on 2012 results. If you look at margins, on margins we outperform all of the oilfield services sector companies in the sector, with the exception of Schlumberger. Based on our fundamental belief that the sector has an undersupply of capability, another metric we monitor is our earnings per employee. We have made strong improvements in this metric in the past, and we expect to continue to do so in the future. We also track return on capital employed, which in 2012 was sector leading. However, we are very conscious that we are now managing a more capital-intensive business. We are disciplined when it comes to investing capital, only doing so where we can leverage our skills and capability. We target post-tax mid-teen returns on our more capital-intensive activities, and we expect our return on capital over our 5-year plans to be significantly higher than 20% and remain one of the highest in the sector. Tim will talk more about our returns later this afternoon. Before I talk about, before I look at our long-term evolution, I just want to take a few minutes and to make some comments about the background to our recent interim management statement. I think this is important. I mean, I think we had a bruising day 2 weeks ago, Monday. But I want to explain it. I think we need to be frank and tell you exactly what happened. When we set our target in 2011 to double net income by 2015, we were coming off the back of 2 strong years of order intake, especially in OEC. We genuinely felt the market was there to continue the strong growth of OEC. Actually, the market was there. The pipeline of bidding opportunities was the same. It's exactly what we saw. And coupled with the growth in IES, based on what we had in the portfolio, executing the projects that we had, and the very clear guidance that we have given for where we saw IES, what we saw IES delivering in 2015, we felt that the two would easily support our 2015 targets with a considerable safety margin. If you look at what happened since, it turned out that the market was there, exactly as we saw it, but what we underestimated was the competitive dynamics. What happened was in 2011 and 2012, we had very intense competition, and many of our competitors won significant work at very low margins, or I could say that below cost. You've seen the result of some of this aggressive pricing in the results and forecasts of many of our competitors. It's important to note that the bidding landscape has improved in recent months. We have more sustainable bidding behavior, and as a result, we have a high success rate when bidding against our peers. And this year is on track to be one of our best in terms of new orders for OEC. By maintaining our bidding disciplines through 2011 and 12, we have a project portfolio today which is in great shape, but as you can see from the chart, the overall growth trajectory has been significantly impacted. If you look at it, it's really the line in between the blue and the red. I mean, it's as simple as that. This has eroded the headroom in terms of delivering our 2015 earning targets. As we laid out in our interim management statement, given the earnings growth expected in 2015 from IES, driven by the anticipated step-up in production from our equity upstream investments, we continue to expect strong year-on-year growth in net income between 14 and 15. However, the achievement of our 2015 earning targets will be dependent on the timing of potential ECOM contract awards during 2014. We have not given up on the target, but we have much less headroom today than we did when we set it in 2011. So to go back to the fundamentals of the market, we have a strong focus on oil and gas, on the oil and gas sector, because we believe it has a very positive fundamentals. E&P companies invest close to $700 billion in CapEx each year, and more than $500 billion in OpEx in the upstream market alone. There is also a large visible market of downstream opportunities with at least $50 billion in the Middle East alone in the next 2 to 3 years. Long term, we believe the upstream market will show growth based on 2 facts. First, there's a solid demand growth largely driven by emerging economies. Most estimates put long-term oil demand growth at around 1%, with gas demand growth almost twice that at about 2% per annum. Second, there is a built-in need for reinvestment driven by the underlying decline of currently producing fields. This decline is of the order of 4 to 5% per year after intervention, and it means that the industry has to work harder just to stand still. So over the long term, you'd expect the growth in upstream CapEx to be at least 5% per annum. In addition, we are increasingly looking at downstream opportunities where we see a number of large-scale projects over the next couple of years, especially in the Middle East. In recent years, we've seen more like 10% annual increases in investment. I think this may slow down next year, and the current estimates for 2014 CapEx growth is in the range of 0 to 5%. However, when you look in detail, some of the sub-segments are doing better than others, and Petrofac is very well positioned against many of these. First, it appears that the Middle East, which enjoys relatively low supply cost, is doing well with the rig count up and Meets construction survey showing 14 and 2015 budgets significantly higher than in 2013. Analysis confirms that the momentum is also good in Asia, CIS, and Latin America. Second, NOCs, which collectively control 80% of combined conventional and unconventional reserves and spend about 40% of total capex, show the strongest increase of investment into 2014. Third, mature fields are playing a growing role. The number of producing fields is growing and the portfolio is aging, which is increasing the spend in this area. There is also a huge potential for enhanced recovery in mature fields. Over the last 20 years, reserve additions to mature fields have outstripped additions through greenfield exploration activity by 30%. These trends are very important drivers for our IES and OPO businesses, particularly in OPO, where we see opportunities to evolve from our duty holder model. Finally, the longer-term trend for the deep offshore is positive, with 2012 and 2013 being very strong years for deepwater exploration license awards, which should lead to healthy growth in deepwater development capex over the next few years. Now, despite the positive long-term macro picture for our sector, it is true that things are getting tighter. The chart on the left, which is from JP Morgan's research, shows the returns from the group's 13 oil companies. This is IOCs mainly. They are over time, how the returns are over time declining compared to the oil price. What's clear is that the interest returns are being squeezed despite oil prices being at record high levels. There are many reasons for this cost inflation. Cost inflation, regulatory pressures, more challenging projects, more challenging molecules to produce, and of course, budget miscalculations. In the past, oil price and reserve upside often saved projects, but this upside may not be there in the future. If you look at the number of projects that were sanctioned by the IOCs 5 or 10 years ago, and you run them at the price that they were sanctioned at, I bet you those projects will be underwater today. And what saved these projects is the fact that people are enjoying today prices, between $100, $110, and a lot of these big fields have grown bigger with the reserve, so you can have the DD&A over a much bigger reserve number. But in a market where you say we're going to have flat oil prices, and where you're developing smaller fields, where the upside in the reserves is maybe not as high, you have to have absolute delivery on time, on budget, to stay within your economics, and that's what is going to happen in the future. If there is, I truly believe that there is significant inefficiency in our industry, as illustrated by the chart on the right, which shows the industry performance on capital projects and operations respectively. A recent survey showed that 66% of large projects were over budget and 72% were behind schedule. On operations, Oil and Gas UK reports that the UKCS production efficiency has dropped from 80% in 2004 to 60% in 2012. A big deterioration at huge cost. We have 40% of the production capacity in the North Sea today, which effectively is shut in, is not producing. Our sector has been plagued by a kind of complacency derived from the historic high returns and margins. It is clear that the industry cannot afford the poor performance to continue. And going forward, our customers will not absorb all the risk while their service companies charge time and material. Increasingly, customers will demand certainty of delivery and budget and will look for 3 things in their suppliers. First, a clear capacity to deliver the work on the ground. Second, a competitive cost base with a culture of cost control and improvement. Third, a willingness to share in the risk of delivery. This can range from lump sum contracts in EPC, through strong performance-related KPIs in operations contracts, right through integrated contracts, which could include alignment through co-investment. I firmly believe that this industry challenge is a huge opportunity for Petrofac to grow our market share. Personally, I think this value arbitrage is our biggest opportunity as a business. And we are determined to capture part of the value that we're going to create for our clients. If I go back to the growth of the business, our growth has been characterized by sequentially expanding our access to oil and gas market. The first phase of growth has been about building and sustaining a world-class onshore EPC business based on excellent project and risk management, strong procurement, and highly differentiated culture and cost base. Marwan will expand on this shortly. The second phase is IES, integrating our services under innovative commercial risk-sharing models to respond to customer needs, particularly on NOCs and niche explorers. Andy is going to give you an update later this afternoon. The third phase is combining our project management, engineering, and offshore strength to grow our offshore EPC capability. I will return to this subject later on. Obviously, throughout, we have been growing our OPO by taking it internationally. We're growing our ECS business, and we're growing our training businesses, and they will be discussed later on by Marwan and Andy. This growth is not just about greater market share. We're absolutely focused on building differentiated positions in each of these new areas so we can deliver the best returns for our efforts. So why should we be successful in evolving our business in this way? Well, there are strong common qualities that run across our company. Of course, the core engineering and operations skills are our bedrock, but the other commonalities are deep and widening technical capabilities, a relentless focus on operational excellence, our commitment to local delivery, our effective risk management, and commercially innovative approach, which has been instrumental in our success. Overall, though, I believe it's our culture which is most important in enabling us to evolve as a company, and we spend a great deal of time developing and celebrating it through our values: safe, ethical, cost and quality conscious, innovative, responsive, and driven to deliver. It is also an important differentiator that Petrofac's management and employees hold a significant shareholding in this business. We think like shareholders with a focus on the long-term success of the business. I would like now to hand over to Marwan, who will talk to you about how we sustain our world-class onshore EPC business. Marwan, please.
Thank you, Ayman. Good afternoon. The focus today is how we continue to build and sustain the onshore EPC business. But I would like first to take a step back to briefly recap on the strategy of Ecom. What do we do in Ecom? We deliver services to a broad range of customers, include both international oil companies and national oil companies, in a wide range of geographies. We do that across the full life cycle of the oil and gas assets, from design and build through to operation, maintenance, management of facility. And we do this both onshore and offshore. We work under a range of commercial models to meet our customer needs, from reimbursable to EPCM to lump sum turnkey. All of those services are underpinned by the core strengths, including a focus on operational excellence, commitment to local delivery, effective risk management, and innovative commercial approaches. How we do it? We do it through 4 business units. The offshore capital projects will be addressed later by Ayman. The OEC, I will come to it now, but I would like, before that, to discuss OPO and ECS. OPO is offshore projects and operations, and ECS is our engineering consulting services. Both OPO and ECS businesses underpin a lot of the group's success and are also expected to play their role in driving the future growth. OPO has a strong position in the UK market, providing key services for around 25% of the UK oil and gas production. We led the innovation of the duty holder model over 15 years ago, and we still have leading position in this market, and we see opportunities to evolve this model. The deep skills and capabilities we have in OPO, as well as the mature systems and procedures developed from working or operating in a highly mature market like UK, have made it possible for us to take over management of mature assets in IAS. We would not have been able to enter Mexico or Romania had we not leveraged on these skills. OPO has delivered excellent growth over the last 3 years. The UK opportunity is still robust. There is, with increasing spend on aging asset base, but we also see good growth internationally, and we are expanding the skills and of OPO into the international market. In Iraq, for example, we have had a good success, and we have revenues around $200 million this year. OPO is also a key to the evolution of our offshore capital projects. Bill Dunnett, the MD of OPO, is here, and I'm sure you will have an opportunity to talk to him and ask him questions about his business. On the other hand side, engineering and consulting services remains the center of excellence for the group. It gives us the technical capability to undertake large-scale projects like Barentai in the offshore and South Yolatan in the onshore. But we are still growing the competency and the capability of this business further. For example, the additional of pipeline design skills and the subsea engineering, which will help support our offshore strategy. Again, Craig Muir, the managing director of this business here, and I hope you will take the opportunity to meet him and ask him any questions you have. Now, to go back to the onshore EPC business. We have an excellent track record of delivering long-term growth in the onshore engineering and construction, and which has driven much of the growth of Petrofac over the last 20 years. We have strongly grown market share, and we have grown from a small private company to a tier 1 EPC contractor. We expanded from the Middle East and North Africa into the Commonwealth of Independent States, and we will selectively pursue opportunities in Asia and Sub-Saharan Africa. After a period of declining backlog following a spell of very competitive bidding in 2011 and 2012, we have now in this year grown backlog strongly once again, and we are poised to return to growth, to revenue growth next year. Now, if we continue to discuss, we have established a strong presence in MENA. We are one of the largest oil and gas EPC contractors in MENA, and we were ranked #1 contractor by the Oil and Gas Middle East magazine for the last 3 years. Our business model enables us to be competitive and to win work at sector-leading margins. How do we do that? First, we have a cost-effective structure with our main operational center in Sharjah in the United Arab Emirates, supported with engineering offices in India and in our local markets. Second, we have focused on delivering high standards with high levels of local content, working with our local contractors and vendors. This not only to meet customers' local content required, but because it is the most cost-effective solution. We'll discuss those a little bit further later on. We have been also forming joint ventures with our peers when required and where our core skills are complementary. We have worked with GS Engineering on NGL4 in Abu Dhabi. We are partnering with DSME over Upper Zakum project. We are bidding with Samsung a multi-billion-dollar projects on the clean fuel refinery in Kuwait. And we have recently announced an award of Suhar refinery with Dalim, among others. And also, we have been working on widening our footprint. Now, we have a bit of a track record on widening our footprint. And over the last decade, we have successfully expanded our geographical footprint with our major EPC projects in Georgia, Russia, Kazakhstan, Turkmenistan, and Shetland in the UK. Our track record outside MENA is very strong, and there is often lower competitive intensity than MENA region. We have expanded to areas where we can manage risks associated with the project delivers effectively, and this enabled us to deliver differentiated margins. In the medium term, we hope to further diversify, moving selectively into Asia and sub-Saharan Africa. Now, let's have a look forward. The bidding pipeline for 214 is attractive, and our high priority prospects totaling approximately $50 billion. This is similar size of opportunity to what we have seen in 213. We see significant opportunity to secure awards in the Middle East and North Africa in markets where we have extensive experience. But also, there is a significant proportion of our 214 bidding pipeline outside MENA, primarily in CIS countries, where we have strong EPC track record as well, such as Kazakhstan. And we hope to convert our early engineering work on KLPE, integrated petrochemical project in Kazakhstan, to an EPC project in 214, and also to secure some more business in Turkmenistan. Given our good historical win rate, the attractive market opportunity, and the improvement in the bidding environment that we are experiencing, we expect to grow onshore engineering and construction backlog across 214. And given the scale of the opportunity, we could deliver a level of new orders similar to 2013. We will be selective, though. We did not bid all the $50 billion of 213. We were very selective in what we bid, and we achieved high success rate in our bidding, and we will do the same in 214. We will continue to target differentiated margin business through expanding geographically and through maintaining focus on operational excellence and cost-effective delivery. And we do that because we continue to deliver sector-leading net margins. Since we came public in 2005, we delivered sector-leading net margins. And the chart reflects a climb of our margins to about 11%. We have consistently outperformed our peers. We never made a loss on a lump sum project. And our EPC portfolio remains in excellent shape. Our net margins in 214 are likely to remain around 11%. 215 net margins are expected to be around 2% lower, principally due to the dilution impact of the minority interest in Abu Dhabi projects. The Abu Dhabi projects will contribute heavily to 215, basically. And we have this dilutive impact because of the minority interest. But we expect revenue growth in 215 to offset the reduction in margin, resulting in OEC net profit being broadly maintained in 215. Going forward, we will maintain our bidding discipline. We expect to continue delivering differentiated sector leading net margins. We have secured $6 billion order intake on onshore engineering and construction in 2009 and 2010. And we have returned to this level in 2013 with order intake close to $5.9 billion year to date. We believe 2011 and 2012 were exceptions in terms of low order intake. We retained our bidding discipline through 2011 and 2010, which were years of very intense competition, and many of our competitors won significant work at very low margins. As a result, we did not build enough backlog in 2011 and 2012 to sustain the revenue growth through 2013. But despite the rephasing of Upper Zakum project in Abu Dhabi, where we have been working on capacity enhancement studies to increase the size of the project, we expect to return to growth in 2014. As Ayman noted earlier, we have been experiencing a difference in the competitive landscape, and it has improved in the recent months. We have seen some sustainable bidding behavior, and as a result, we have high success rate when bidding against our peers, and this year is on track to be one of our best years in terms of new order intake. Our success rate has been one of the highest this year. We have not changed our bidding policies or our bidding strategies. We are bidding at the same levels that we were bidding in 2011 to 2012, but we are winning more business. Now, we keep talking about bidding discipline or being disciplined in our bidding and execution. So what do we mean by that? We believe that we enjoy the sector-leading margin because we have a disciplined approach of securing a new business, and we have an excellent project delivery. Now, what does that mean? We have the phases. The chart shows the phases of how we secure business, or basically it summarizes that. The thorough screening, we do a thorough screening, and we are selective in what we bid. And we ask few questions before we select what we bid. One of the questions, can we win when we bid this job? Second question, can we execute and deliver a high-class performance on that job? And the third question, can we secure differentiated margin? So we have a process that goes through those three main questions, among other questions. Is this the right country? Is this the right client? It addresses the security in the country. It addresses the risks associated with the client, with partners, etc., things like that. And then we select what we bid. That's why we can secure a high success rate with higher margins. And then we pre-invest in the bidding. We spend a lot of effort and money on bidding. We treat each bid as a project, and a project manager and a team is assigned to that bid, and they start analyzing the bid as if it is a project that they have to execute, delivering an execution plan, looking at where they are going to buy, whom they are going to subcontract, basically working out all the details of the execution plan. We don't price only quantities, we price an execution plan on each project. And then we go into the costing and the de-risking. We do what we call zero estimate by going through a lot of details on taking off all the quantities, all the equipment, issuing inquiries to the market, negotiating with vendors, with subcontractors, aligning subcontractors with us on back-to-back basis on terms and conditions, etc., and things like that to come up with the cost. So we cost the quantities, we cost the execution plan, and who is doing it? Project management and a team, not only proposals department interested in winning the job, because those people will, in 90% of the cases, continue to lead the job. So their interest is aligned and they want to have a successful job. And then we have a very disciplined and structured approach to assessing risks and pricing risks or mitigating risk. And that involves the senior management. And the senior management are the one who makes decisions on the risk, contingency, and the pricing in the end. Doing all of this helps us during the project execution. It gets us a head start in the project execution. So we say we have a project delivery which is best in class. What's that? I mean, what we believe we have is that we have a culture that has helped us consistently to ensure best in class project delivery. What is this culture? Maybe it is our ability to strike the right balance between empowering and actively monitoring project execution. Each project has a tailor-made execution plan which starts from the bidding period, basically. And the project team are empowered and incentivized to deliver. But there's an ongoing active monitoring by senior management, including our group CEO, Ayman. There's weekly meetings to discuss the exceptions on the projects, 2 monthly and quarterly meeting, and management meeting on the project. The idea is to have an ability to foresee and predict problems and risks ahead of time and to respond to them quickly. Not that we don't face problems and challenges. The differentiator is our ability to make the decision and respond quickly to the problem so that we mitigate the impact of those problems. We ensure that we have excellent relations with our vendors and subcontractors, and we are aligned with them. We have a high level of attention to details, fast decision-making process, basically. I'll just give you an example. On one of the projects, there was some challenges because it's a brownfield project, and the client team and all the planning forecasted about 15 months delay. Our intervention and the way we did the work and responded to that, we finished the job on time to the satisfaction of the client with a very high standard, and it is considered a best in class in delivery. And when we talk about best in class in delivery, this year we have managed to complete 4 mega projects in 2013, multi-billion-dollar projects. The South Yolotan project in Turkmenistan, $3.4 billion project, EPC contract in Turkmenistan, extreme hard, tough conditions for logistics. We have done this job EPC, including commissioning, ready for startup in 34 months, 35 months. ASA project, basically in Abu Dhabi, 220,000 cubic meters of concrete, 40,000 tons of structural steel, 25,000 tons of equipment, 30,000 tons in piping. The biggest quantity of commodities ever have been executed in Abu Dhabi, basically. It has been finished, handed over to the client. It is considered by our client the best in their portfolio. Al-Merk, in the desert, basically, faced with challenges of importing of material, changes in law, social disturbances, where our subcontractors were removed from the country. They were denied visas. We responded, we trained people, we used local subcontractors, and we finished the job on time to the satisfaction of our client. And NGL4, maybe the biggest brownfield project, $2.1 billion of brownfield project that happened in Abu Dhabi. Again, finished on time, commissioned, ready for handover this year. Now, we do all of this, but we are not complacent. We still strive for improvement and for operational excellence. And for the last 2 years, we have an initiative led by Sharma, who's here as well. He is the MD for our onshore engineering and construction, and he will be available for interacting with you. He led an initiative to improve our organization and operational efficiency. And it's basically split into 4 basic modules: design optimization, organizational efficiency, execution model, and construction model. Design optimization is basically to optimize our engineering design, maximize our efficiencies in bidding and execution. And what we have done, we have established from our best projects benchmarks. And those are solid benchmark, measurable benchmarks, so that each project we are doing, each project that is being executed, is measured against them during the execution. Like, for example, we have man hours per line. How many man hours we spend per line in a green field, say 65. How many man hours we do for a brown field. How much concrete per metric ton of steel we should have on a project, and we have a range maybe between 1 to 1.3, 1.2 to 1.5 cubic meter. How many tons of pipe supports per ton of piping, and we have a range, 0.19 to 0.3 tons per ton of piping. Those are some of the measures. How many elbows per kilometer we put. And each project measures those, and we check that the project is within an acceptable range. And this is very important for our cost efficiency, effectiveness, and basically and ability to deliver on time. Organizational efficiency is optimizing the use of our lower cost engineering centers. A few years back, when we started loading more work into our India office, we were looking at maybe first we started with 70%, we do it in Sharjah, 30% in India. And then we evolved to 50-50. Now, what we are aspiring this year to achieve is a 20% of the workload is in Sharjah and 80% in India. And this is ahead of all of our competitors. A lot of our competitors, they have offices in India, and they have the same low-cost center. But the differentiator is our ability to utilize those offices effectively. And we have developed systems in place. We bring people in India at the beginning of the job, they become part of the job, then they carry this and go with them, and the interface between Sharjah and India has become seamless. So we are working across the two offices as if it's an extension of that office. So our ability to do this 80% is credible, and we hopefully will achieve it. Our execution model, we have a strong belief that we are delivering the job on site, not in the office. So our execution model is construction driven. We think backwards. We do the thing backwards. We plan backwards. And we start thinking by what we call required on-site dates. We want to know at the early part of the job, when do we need to have the drawings for every aspect or for every part of the job? When we need to have the material available on site? When do we need to deliver this? And we start monitoring the project on that basis. Our execution models allow us to have the ability to predict if there's problem. We have leading indicators to see that there's problems that could affect the site, basically, and the delivery on site. And lastly, the construction model, where we are looking to improve our overall efficiency in construction, reducing the cost by revisiting our subcontracting strategy, selecting the optimum subcontracting strategy per location, per project, depending on the project. Creating alignment with our subcontractors and have with them back-to-back agreement in terms of the risks that we are taking and in terms of the rewards, basically, sort of like partnership. Depending heavily on local workforces. For example, in Algeria, I mentioned that earlier, we had a problem with our foreign workforce that was denied visas. We started a training school. We trained 2,000, 3,000 people, local people, in various activities, and that we mobilized them to the site, and that helped us to recover the delay on the job and deliver the job. In Turkmenistan, we also started a training school, vocational training, carpenters, steel fixers, masons, etc. And we took people from the country, and we trained 7,500 people, basically, to do the job. And that saved us importing labor from outside. And that's a much more cost-effective scenario for us. And we finished the job with about 73% local content on the job. So our continuous focus on operational excellence should ensure we continue to deliver high-quality project and deliver differentiated sector-leading margin. I mean, somebody is going to say, okay, so what does that mean? We truly believe that our cost base as Petrofac is between 2 to 4% lower than our competitors. And this 2 to 4% is what we are pricing in at the moment. That's how we price higher margins, and we still win projects. So in summary, the onshore market opportunity remains robust, and we expect to continue to grow our onshore engineering and construction backlog across 2014. We have differentiated ourselves through bidding discipline and consistent delivery, underpinned by our core skills and capabilities. And as a result, we have an EPC portfolio which is in excellent shape and has protected shareholder value. However, we are not complacent, and we will continue working hard to continuously improve with a focus on organizational and operational excellence. And we will continue to bid in disciplined manner, and we expect to continue to deliver differentiated sector-leading margins. Now, I will hand over to Andy to update you on the progress of integrated energy services.
Thank you, Marwan. Today I want to review the strategy for IES that we first articulated at the Capital Markets Day in June 2011 and demonstrate the progress we've made. In particular, I want to highlight the growing operational momentum in IES and outline the milestones that will deliver the 2015 promises, as well as the strength of the portfolio that will sustain the IES earnings to the end of the decade and beyond. The fundamental premise which underpins our strategy is that the upstream industry is short of capability. And those industry players with growing capability gaps are looking for innovative ways in which they can source that expertise. Our response to this market pull is our integrated services offer, which allows us to earn a differentiated margin for the capability we provide. Our focus is on the NOCs, who are sitting on a vast potential in their mature fields, often operating well below their peak. In addition, we're responding to the niche explorers who are seeking to move from exploration to development and require the capability and capital to do so. We provide these services through innovative commercial models which balance risk and reward and do not necessitate the booking of reserves. And wherever possible, we leverage our own internal service capability to maximize operational efficiencies. So, who do we serve? 2 years ago, we flagged our intent to pursue opportunities in countries that offered significant resource potential, recurring opportunities, and where we had a relationship and capability to deliver locally. We identified 5 key areas: Southeast Asia, West Africa, Middle East and North Africa, Mexico, and the former Soviet Union. And we've stuck to that framework with a strong and growing pipeline of contracts and opportunities with Petronas, with Pertamina, NPDC, Pemex, KMG, and others. In Nigeria, we announced earlier this week the signing of a memorandum of understanding with the Nigerian Petroleum Development Company. This MOU will enable us to pursue asset development opportunities with NPDC, the first of which is the offshore block OML 119. Together with Televares, a local Nigerian oil and gas company, we've agreed to provide technical and financial support together with the building of capability on OML 119 under a risk service contract whereby the reserves and license ownership are retained by NPDC. In addition, the Bolevin deal has attracted a series of new players into our pipeline. The niche explorers require capability and sometimes capital to convert opportunities from exploration to development, and we are in discussions with other companies. So what do we offer? I want to remind you how we deliver our services using 3 commercial models. The risk service contract, in which we develop, operate, and ultimately transfer a greenfield asset. The production enhancement contract, in which we manage a mature field to improve production. And the traditional upstream equity contract, whether this is a PSC or a tax and royalty contract. I want to stress we are not an oil company. We have no incentive to book reserves and production. Instead, we're looking to create value by leveraging our capability. In our portfolio, we have a growing list of examples of each of these models, and our primary focus since the creation of IES has been on PECs and RSCs. Each of the models is designed to address the goals of the resource holder and reward Petrofac for the value that it adds. I now want to describe in more detail how we do that using some specific examples. There are three drivers of our business performance. First, at the core of our offering is our ability to integrate Petrofac services to add value for our customers by delivering faster and more effectively. At the same time, we create track record and backlog for the Petrofac Group. Second, whether it's an appraised greenfield opportunity that the resource holder is struggling to make economic, or a mature field operating below its potential, we redevelop the reservoir. This is about bringing our capability and a new mindset to identify opportunities that the resource holder has left behind. And finally, we then need to deliver that opportunity set in a cost-effective way that creates value for the resource holder and margin for ourselves. Equally important is our license to operate. Many of our contracts span decades, and this means we need to deliver safely and ensure asset integrity, maintain a strong relationship with the community, build local capability, and finally, grow our customer relationships. Taken together, this is how we define operational excellence in IES. And I want to take you through those examples, starting with the Berantai project. Berantai is an offshore, greenfield, billion-dollar-plus gas development in Malaysia, which we delivered in 21 months from FID through to first gas, best in class for the industry. Rob Dukes, the Managing Director for Developments, is here today, and after the formal presentation, we'll be able to talk you through Berantai in more detail. Key to our success on this project was the integration of services across the whole Petrofac Group, which covered conceptual engineering, FEED and detailed design, the procurement, construction and pre-commissioning, commissioning and operations, and then the overall asset management, including the subsurface drilling and training. Having all of this service capability in-house allowed us to accelerate delivery through reduced interfaces and to drive project efficiencies. And finally, not only did we create backlog from these services for the Petrofac Group, but we extended our track record in offshore developments and built confidence for the continued growth of that offshore strategy, which Ayman is going to cover next. And we're now working with Petronas to develop plans for further development of the Berantai field, which, as we highlighted in our recent IMS, is likely to entail a phased investment program from 2014 onwards. Moving on to Mexico, where we've had great success in growing production on Manganales and Santuario by over 50% since we took over these fields. And most importantly, for the longer term, we've also grown the resource base. Again, Gordon East, the MD for Production Solutions, is here today, and he's led the growth of our business in Mexico. At the time of the bid, we anticipated production over the life of the contract on Manganales and Santuario of approximately 60 million barrels each. Through our detailed field development process, we've gone back and rebuilt the reservoir models using the latest seismic and all of the existing well data, and have identified new opportunities which have grown the resource base by over 10%. We've accessed these opportunities using new technology, For example, we've drilled 4 horizontal wells, the first on these fields, at an average cost of $4 million per well, to deliver rates of around 1,000 barrels per day. This compares with vertical wells, which cost $3 million and deliver only 250 barrels per day. And most exciting, our review of the seismic has identified a series of near-field opportunities, some 7 on Maganales and Santuario alone. We've drilled the first opportunity, fault block 401 on Santuario, with great success. Our assessment of this appraisal well is that the oil in place on this fault block, which is at the original field pressure, is around 150 million barrels, a significant upside, adding potentially another 50 million barrels of production over the life of the contract. So compared to our assessment of the contract production at the time of the bid, we've already doubled the resource base on Santuario, with a similar uplift in the overall profit over the life of the contract. And there's more to go. We're currently drilling the second fault block, you can see in that chart. And all of this points to the significant long-term potential of these contracts. Having grown the resource base, we then need to deliver it in a cost-effective way. This is all about creating a performance culture which owns delivery, knows what good looks like, and relentlessly closes the gap. This chart shows our drilling performance in Mexico. We establish what good looks like by setting the technical limit. This is a process whereby the drilling of a well is broken down into its hour-by-hour activities by the rig crew, and the best possible time for each of these activities is established and then aggregated to create the technical limit. As you can see, we're drilling close to this limit and 55% more efficiently than prior performance. This performance ranks us in the top quartile of operators in the region and ultimately translates to more profit earned from our dollar per barrel tariff. We've achieved this success using our know-how, but depending on the external supply chain for equipment and contractors. We recently established a service company with Grupo Alfa in Mexico, which will bring these services in-house. This involves investing in equipment, including land rigs, lift units, test equipment, and providing integrated services using this equipment against Pemex-established price books. Initially, we'll direct this capability to the PECs we've secured, but we'll then look to accelerate the growth of this service company by looking for external customers in the region. So the establishment of this internal capability through Petro Alfa will further enhance our ability to drive cost efficiencies in country. So as you look back over the last 2 years, we've delivered a significant growth in net income, but most importantly, we've accelerated operational momentum with a real focus on how we add value through the integrated offer. We've demonstrated successful delivery of that offer. We've strengthened our organization and its capability. For example, we now have over 300 petrotechnical professionals spanning disciplines from the geoscience through to production operations, a threefold increase since 2011. We've also increased our operational centers from 3 to 5 and doubled the backlog. So looking to the future, what do we need to do over the next 2 years to deliver $300 million of net income in 2015? The key milestones for you to monitor are, on PM304, achieve first production from phase 2 in the second half of 2014 to support ramp-up of production from the field. On Greater Stella, achieve first production in late 2014 and on plateau in 2015. On Burantai, in 2014, start the second phase of drilling of the main Burantai field and conduct appraisal of the western side of the field. In Mexico, it's about continued growth from the base and generate net income from Petro Alfa in 2014 and achieve first production from the recent appraisal success in Santuario 401 in 2015. With a further contribution from a conversion of a small number of new projects in the pipeline, including the recently announced RSC on OML 119. And then as we look beyond 2015 to the end of the decade, what's going to sustain that growth? First, we've grown the potential of our existing assets this year. On PM304, we've had appraisal success on the Central Graben, East Eseru and East Chendor fault blocks, and have grown the oil in place by over 300 million barrels. PM304 now has over 1 billion barrels in place, and the currently sanctioned projects develop just 122 million barrels of that resource. We expect the field to reach plateau production in 2016, and with this additional resource, there's the potential to maintain that plateau through to the end of the decade. As I've illustrated, we're also growing the resource base in Mexico. The near-field opportunity that we've drilled has added approximately 50 million barrels of contract production. And there are 6 other near-field opportunities to drill on Santuario and Manganales, with more to add on Panuco and Arenque. On Churgi, we're tying back 2 additional wells by the first quarter of 2014, and will boost production and extend plateau. And finally, on Greater Stella, there's the potential for third-party tiebacks to the floating production facility to create additional income. This growth in the resource base, with the prospect of a successful final investment decision on the Ntinde project in Cameroon, forms a strong foundation for IES earnings over the next 5 years. Our evaluation of these investments shows that we expect to deliver post-tax returns in the mid-teens from our portfolio of development projects. And finally, we're confident of building on this firm foundation through the disciplined addition of new business from a strong pipeline of opportunities. So, in conclusion, our strategic approach is strong and underpinned by the delivery of our integrated service offer to an industry which is growing short of capability. The opportunity set is large, with pull from both the NOCs and the niche explorers. Since the inception of IES more than 2 years ago, we've significantly grown our capability and are building operational momentum across the business. And in this time, we've built a business of scale with a strong portfolio of projects. Most importantly, we can continue to grow through the expansion of that resource base on our current projects and the disciplined addition of new projects. I now want to hand over to Ayman to cover our offshore EPCI business.
Thank you. Thank you, Andy. Thank you. I'm going to give you a brief update on where we are with our offshore capital project strategy. I want to point out, first of all, that we have more than 30 years of experience working offshore. That experience is rooted in the history and excellence of the UK North Sea and its intense focus on safety and asset integrity. Over the last 10 years, we have been increasingly active in delivering EPCI projects. They've been mostly in shallow waters, both in the UKCS as well as Malaysia. And we've delivered several $1 billion of offshore projects under a range of commercial arrangements. The latest of these is SAR project in Abu Dhabi, where we're undertaking a $500 million EPCI project. Over the last 2 years, we have expanded our offshore capabilities through the acquisition of RNZ in Malaysia and the SURF design specialist KW Offshore. This has led to our first deepwater win in Mexico, where we are helping Pemex deliver their first deepwater project with project management contract for the Lakach development. Let me turn back to the market opportunity. There is no shortage of market information available, much of it from the analysts here today. But for those of you less familiar with the market, I'll give you a very brief overview. In summary, the market dynamics for offshore are compelling. Offshore oil and gas production is expected to grow to around 40% of global production by 2025, with production from deepwater developments expected to grow fastest, increasing from around 5% of global production today to around 13% by 2025. To achieve the substantial increase in offshore production, capital expenditure is expected to grow more strongly than the overall oil and gas market. The SURF market alone is expected to more than double between 2013 and 2020. Analysis of offshore development also shows that most offshore projects are economic at oil prices well below where they are today. And as a result, we expect these projects to be less sensitive to changes in oil prices compared with frontier developments such as the Arctic, tight oil, and oil sands. Furthermore, offshore projects are also less exposed to many of the social and political risks that can impact onshore projects. Turning to our strategy. We are building on our core skills and capabilities to deliver a differentiated EPCI strategy. We aim to build a top-tier offshore EPCI business, which will access high-end turnkey opportunities where there is significant EPC content over and above the value of the installation services. Our strategy is not, and I repeat, it's not about building a day rate installation business. We see our strategy as a natural progression of our existing activities. We have a strong track record in EPC project management, substantial offshore expertise, an experienced management team who have consistently delivered on its strategy. Our offshore EPCI business will expand our access to offshore facilities work, access deepwater and SURF markets, and selectively address floating production and pipeline works. Our approach to offshore EPC will be similar to that for onshore EPC. We will manage a small portfolio of large contracts with a rigorous focus on risk management. Our customers will be the IOCs and NOCs, and our geographic focus will be on areas where we have existing capability and/or execution track record. For example, in West Africa or in Mexico. We will look at other areas selectively. You may have read in Upstream a few weeks ago that we have pre-qualified for the Bonga Southwest Aparo project in Nigeria, which demonstrates that we have already been successful in building capability and gaining the confidence of our customers. This strategy is strongly enabled by the core competencies I've already discussed, namely engineering, project management, risk management, and our innovative commercial model. Of course, the move into deeper water requires us to selectively build on our existing technical skills and capabilities, and I'll update you on that in a minute. However, it is not possible for us to get into the deepwater EPCI market without an enabler, which is a high-end installation capability. Believe me, if this installation capability was available to rent in the market, we would rent it and we would not invest in it. As there is not currently a liquid rental market for this high-end installation capability, we are building our own vessel to access the market and to de-risk EPCI delivery. The investment in a vessel also helps us attract the very best talent in this business. Consistent with our approach to ownership of assets in our onshore E&C business, we will not seek to own vessels at the lower, more commoditized end of the market, and will partner with local contractors, long-term charter, or rent vessels as needed. This is exactly what we do in the onshore business. There are plenty of suppliers. It's a commoditized construction business. You can go to multiple providers of the construction capability, and we partner with the best suited. But when it comes to the high end, we can't do that, and that's exactly why we're doing this. We are currently having discussions with a number of contractors who are eager to partner with us on EPCI projects. Let me first talk about what we've done with building the team. We have great leadership of the team through Yves Imbona. Yves is with us also this afternoon. He's here. And he has many years of experience in the offshore industry. We've also successfully recruited a number of key positions in the offshore EPCI team over the last few months, including in marine operations and installation. These key specialists have helped us to fine-tune the design of our installation vessel. Both Yves Mbona and Kimon Ardavanes, Senior Vice President Operations, are with us today. I will be happy to answer any more detailed questions you may have in the breakout session. Our offshore facilities engineering is being grown through organic enhancement of our existing engineering capabilities in Sharjah, Kuala Lumpur, Chennai, and Woking. And our existing Sharjah and Kuala Lumpur offshore pipeline design skills were recently augmented through the acquisition of KW Limited and RNZ, and are being extended with further deepwater design expertise. I'm very pleased with our progress to date in building our offshore EPCI team. Turning now to look at our enabling asset. Our installation vessel delivers a unique combination of high-end capabilities. Our investment represents the minimum investment necessary to access high-end EPCI markets, to de-risk delivery and attract capability. With one key enabling asset, we do not share the same concerns over utilization that other top-tier contractors do. Our peers have around 30 to 40 vessels in their fleets and therefore have to focus on utilization. We do not expect this to be an issue. Our aim is to focus on offshore projects with a high level of EPC content over and above the installation scope. But we can also use the vessel on decommissioning projects and to support our offshore projects in IES, where we currently today use around 200 days of installation capability per year. And we have that visibility over the next 2 or 3 years, similar requirement. Combining the high-end capabilities on one vessel, therefore, lowers the risk of the vessel downtime as well as minimizes our capital outlay. Our capital outlay is expected to be around half of what it would have cost to have the same capability spread over 3 vessels. Tim will talk about our investment plans for the offshore strategy in a few minutes. Let me tell you where we are with our Petrofac 6000. This is the name of the vessel. We placed the letters of intent in July for the design and manufacture of most of the time-critical equipment. The main heavy lift crane, 5,000 to 6,000 tons, depending on the application, has been ordered. The foredeck cranes and the 2,000 metric ton J-lay tower. Since then, we've ordered the other main equipment such as tensioners, deepwater abandonment, and recovery winches. Our approach de-risks the shipyard construction cost and schedule by fully detailing the engineering interfaces between critical equipment design and manufacturers and the shipyard prior to placing a firm shipyard order. Negotiations with the shipyards are progressing well and in line with our target of having the vessel available from early 2017. This is consistent with us bidding for work in 2014 and targeting awards in 2015. In terms of the specification, this slide shows how the Petrofac 6000 compares with what is available in the market at the moment and what is expected to be available in the near future. We expect the Petrofac 6000 will be best in class. It will be number 1 for deepwater pipelay. It will have the highest lift on a dynamic positioning monohull vessel, and it will be in the top league for double joint shallow water pipelay. We are confident that the Petrofac 6000 will enable us to access high-end turnkey EPCI projects. This is a busy slide here. I don't intend to take you through the detail on this slide, but it shows part of the detailed market analysis that we undertook before embarking on our offshore EPCI strategy. While much of the market is commoditized with excess capacity, the high end of the offshore EPCI market is very different, with demand outstripping supply. We have seen recent consolidation in the top tier of the offshore market, with some high-profile mergers and alliance agreements. We believe this creates an opportunity for a new entrant in the high-end market. Given our track record in managing large-scale EPC projects and our extensive offshore experience, we believe that we have the right set of core skills and capabilities to access the high-end EPCI market. We recognize that we need to continue to build upon these core skills and capabilities. We have mapped our current capabilities and identified all the skill gaps which we are actively addressing today. We believe we are very well equipped to become a top-tier offshore EPCI contractor and to execute very effectively. In summary, we have a strong offshore record both in O&M as well as capital projects. The offshore market opportunity is attractive with high levels of capex growth expected over the next few years, especially in deeper water. Our strategy is to build a top-tier EPCI player, to be a top-tier EPCI player with access to the most attractive markets. This strategy will build on our existing core skills and capabilities. The Petrofac 6000 will enable our strategy. We expect to deliver mid-teen post-tax returns from the Petrofac 6000 and its associated EPCI work. Including our existing shallow water EPC business, we expect to grow our offshore capital projects business, EPCI revenue, to over $2 billion by year 2020. And this will become a significant contributor to the group's revenues and which should deliver healthy margins. I'll now hand you over to Tim, who will provide a brief update on our financial position before I return to sum up and open the floor to Q&A.
Thanks, Ayman. Good afternoon. I'm going to briefly run through how our returns and financial position are expected to develop going forwards. Over the last few years, we've delivered an exceptionally high return on capital employed, largely driven by our onshore engineering construction business, which has a very low capital requirement. Our return on capital employed has recently decreased as we've been investing in IES. However, it remains considerably higher than the majority of our peers. Given the ongoing investment we'll be making in IES and our offshore strategy, return on capital employed is likely to decrease somewhat going forwards. However, our expected business mix is such that we anticipate return on capital employed remaining significantly higher than 20% moving forwards, which should still be one of the highest in the oilfield services sector. Turning now to look at our IES and offshore investment. We expect to invest around $1 billion each year on average in IES over the next few years. Including investment in new projects, the portfolio is expected to become self-financing from 2016 onwards. And our existing portfolio is expected to be broadly cash break-even in 2015. Due to commercial sensitivity, we cannot disclose returns on individual IES projects. However, as Andy described earlier, based on our current evaluation of our portfolio development projects, we expect to deliver post-tax returns in the mid-teens. As for our guidance earlier this year, we expect to invest around $1 billion in our deepwater offshore strategy over the next 5 years, with the majority of that spend on our installation vessel. We will only spend over and above the cost of the installation vessel where we cannot access the capability in the rental market. In assessing whether to invest capital in our offshore business, we clearly looked at the returns that we could earn elsewhere in our portfolio. And factoring in the profit from the engineering, procurement, construction and installation of the offshore projects, we expect returns to be comparable with the mid-teen returns from IES. This assumes a relatively prudent build-up of new orders and a modest EPC factor. That is the total value of an offshore project in relation to the installation component. Turning now to look at our financial position. Until late 2012, we had a substantial net cash position, bolstered by cash advances from our onshore engineering construction portfolio. We've recently entered a period where we'll be in a net debt position as cash advances on a number of the major projects which Marwan mentioned earlier have unwound, and we're investing capital in IES and our offshore strategy. In our early years of growth, our customers looked to our net cash position to give them comfort on our long-term financial strength. Given our current scale and business mix, we're now able to run a more efficient capital structure, carrying modest net debt with our financial strength measured by way of our public credit ratings. While it's not a financial covenant placed on us by our lenders, we have an internal target for net debt not to exceed 1x EBITDA. We plan to manage our business to ensure we remain within this range going forwards. We have substantial liquidity available to us from our $750 million debut bond issue, which was launched in October. We have a largely undrawn $1.2 billion revolving credit facility in place. After a period of higher capital intensity, we expect the group to return to a cash-generative position midway through our 5-year planning horizon. Within all our plans, our dividend payout ratio is fixed at 35%. So in summary, our return on capital employed is expected to remain significantly higher than 20% going forwards, one of the highest returns in the oilfield services sector. Our offshore strategy is expected to deliver capital returns in line with the mid-teen post-tax returns anticipated from integrated energy services. As we complete our offshore investment and IES becomes cash generative, we expect the group as a whole to return to free cash flow generation. And we have financial flexibility with a strong balance sheet and a robust liquidity position. And I'll pass back to Ayman to sum up today's key points.
Thank you, Tim. And thanks to all the presenters this afternoon. In summary, we're focused on the oil and gas sector and are differentiated through the first-class execution, our innovative commercial approach, commitment to local delivery, and unique culture. Our market has good fundamentals, and we're enhancing our access to attractive subsectors through the expansion of our skills, constantly seeking the best return from our capabilities. Our strategic evolution is characterized by 3 main phases of growth, all of which are supported by our core engineering and operations skills. First, building on and sustaining a world-class onshore EPC business, while continuing to grow both our OPO and ECS, Engineering Consulting Services. The second phase was delivering our integrated energy services. And the third, growing and enhancing our offshore EPC capability. Our portfolio is maturing in geographic and business model mix with a more balanced exposure to different phases of the industry life cycle. Our balance sheet remains strong, and we expect to deliver one of the highest returns on capital in the oilfield services sector. We continue to build on our excellent track record, and we see significant long-term growth potential for Petrofac. I'd now like to invite your questions. There are microphones between the back of the seats in front of you. Please press the button in the microphone once to turn it on, and the red light should appear. And please give us your name and institution where you work. I will be happy to take the questions with my colleagues. Let's start with you, Christian.
Good afternoon, Christian Malik from Nomura. 2 questions, if I may. First, on your onshore margins. You reiterated differentiated sector leading. What does that mean longer term, given at the moment the average is closer to 5%? Can you give us quantify a range of where you think margins are trending towards, particularly if the competition does continue to stay quite intense? And secondly, on your returns outlook, you mentioned significantly higher than 20%. Again, can you quantify the pace of that decline? And is it over 2 to 3 years, or is it when do you expect to achieve that 20%? And thank you very much.
Can I answer the margin one, and then I think on the margin one, Christian, we could not be more specific. We are saying that we anticipate 2014 to remain broadly around 11%. We said that in 2015 we expect a drop of about 2%, largely driven by the fact that we have a lot of the Abu Dhabi business where 25% minority interest is netted out. We continue to bid, and we also said that we believe that we have a cost advantage because of everything we're doing of 2 to 4%. We continue to bid to generate sector-leading margins. I really cannot tell you where we're going to be in 2016 and 2017. I expect it will be sector-leading because of the structural advantage we have. We obviously will aspire to do as well as we can. But today, based on the portfolio that we have, we are giving you very specific guidance on margin in 14 and 15. We will always strive to generate the best margin we can generate, but it's a bit early today. It will depend on what we sell and what we see in the market. What we're seeing right now in terms of the competitiveness of the market is much better than what we saw in 2011 or 12. So hopefully this will provide us the opportunity to continue to generate sector-leading margins. And on the...
Yeah, Christian, on the return on capital employed point, I mean, we are clearly investing in IS at the moment, and we'll be making initial down payments on the vessel fairly shortly. That therefore means 2013, you'll probably be still in the low 30% return on capital employed level. As you move into 14 and 15, you'll see it moving into the 20s. I did say significantly higher than 20. We're not expecting to dip down as far as 20. And it kind of stays there for the next 3 or 4 years. And then once the vessel moves into operation, you'll see it moving back up again. But it kind of ends up in that kind of 25 to 30% level over the next 4 or 5 years.
Just to follow up on the long-term margin, so would it be fair to assume, and not to put words in your mouth, that 9% is a sensible view longer term, if we project?
Well, I mean, it's very difficult for me to be specific, but I see no reason why that should not be achieved.
Right, just to follow up on offshore, again, apologies. On offshore, the returns outlook for the peer group at the moment, Subsea 7, Saipem and Technip, what sort of pricing have you baked into your returns view in the context of where demand is today for offshore subsea? And given there are a number, one particular competitor that does have a lot of new investment that's coming onto the market, where do you see pricing going, and what's your base case?
As I mentioned, Christian, in the calculation of the returns on capital employed, we've assumed a fairly prudent build-up of the business once the vessel comes into use, and also a fairly prudent EPCI factor. But to be clear, in working out the returns to the vessel, we have taken into account the additional revenues and margins we get from the EPC work, because the vessel is an enabler. So this is not just the return you get from ownership of the vessel, it's the return from what you can do with the vessel.
Thank you.
Hi, it's Mick Pickup here at Barclays. A couple of questions, if I may, on the offshore business. So I think part of your unique success in the onshore has been your commitment to local content. I didn't see any commitment to local content in the offshore, so can you just talk about that? Secondly, just on the specifications, a 2,000-ton J-lay tower, a 5,000-ton crane. I can't believe there's been many jobs that need a 2,000-ton J-lay tower ever, and 5,000-ton cranes probably once or twice a year. Now, you did also mention that you were going to spend potentially 200 days in IES. That does seem like a sledgehammer to crack a nut in IES. So what is it in IES that needs that type of capabilities, and how are you going to price that vessel into IES?
Okay, well, I mean, for the first, to answer the first question, what we said very clearly is we will partner with, we'll have partners in to provide the other assets. So if we work in Malaysia, we will partner with Sapura Kencana. We are talking to a number of local partners in West Africa as we speak, and in fact, the qualification that we had for Bonga was with a local partner. So that's what we will do in every geography. On the other question, I will have as a request Yves to answer you specifically on the J-lay and the 5,000-ton crane. But we are not building this for IES. We have said very clearly that we're building this because of the market outside. But we said within IES, we're doing today offshore EPIC business today. And part of what we have to deliver on Etinde for in Bolivian is part of what we're bringing is that our ability to cap the exposure and provide a lump sum turnkey and put some capital behind it in order to get debt for the entire development. And everything we're looking at in the deepwater, in the offshore market, is around being able to de-risk the execution by bringing an integrated offering. So IES has the offshore EPIC, but we're not necessarily saying in that offshore EPIC we're going to necessarily use this particular vessel. But maybe, Eve, you can talk about the 5,000-ton crane and the 2,000 JLA.
Yes.
Come on. It's come on.
Is it on? Okay. No, regarding the 2,000-ton jelly tower, I think this you are touching like a general aspect of the offshore. Either you are or you are not. It's not that when you have top-end capability, you will use it every day. Nobody uses a craneage at the top of the capability. So is the case for the jelly tower. However, we see a market, and the one that Ayman mentioned on which we are pre-qualified, is definitely using top-end capability. You know that regarding the jelly tower, now clients ask us to be able to hand floated pipes, do pipe-in-pipe laying, so the high-end capability will be used in the project, and even if it's 1 month or 2 out of a 6 months project. So definitely the capability is part of the pre-qualifying. Then having this plus the crane is a big advantage when you do steel catenary risers and you hand them over to the FPSOs. So definitely it's not about using the maximum capability all time. It's about being pre-qualified on the project and delivering the additional EPC content.
Please.
Thanks, Simon. Rob Pauline from Morgan Stanley. A couple of questions, if I may. First of all, to what extent do you think you'll be able to leverage Schlumberger's renewed focus on its IPM business, particularly relating to onshore, or is the IES sort of outlook that Andy outlined much more of a sort of independent Petrofac track? And secondly, on the outlook for contract awards in OEC, a little while ago we heard a lot about Algeria and how there was lots of contracts in Algeria coming up. That seems to have sort of disappeared off the sort of agenda. Maybe you could give a quick update on how the bidding pipeline looks there. Thank you.
I will request Andy to speak about Schlumberger, and then I'll talk about Algeria.
Yeah, on Schlumberger, obviously our first contract together was Panuco, and that's in the evaluation stage at the moment, the first 2 years, working well together, and the combination of capabilities we're bringing is creating a lot of optionality on that field. So, going well. We're bidding on a number of other opportunities at the moment. And I think what we're doing is being very focused on things where the combination of skills that we have, particularly their deep subsurface knowledge, our surface capability and operations, putting those together and ensuring that is there an opportunity there where 1 + 1 is greater than 2. And I think that's what you'll see us do. So, very much something that we're working on very closely, but we're being very focused about what it is we work on. And Panuco is a good example of that. We've clearly established a strong operational base in Mexico where we can leverage that, and we're bringing their subsurface innovation. It's about drilling. There's a steam flood pilot on Panuco. They're bringing that technology. So the combination is working together very well.
And on Algeria, we have had an award recently in Al-Rar. We have at least three bids where we anticipate awards in sometime in 2014. So Algeria for us is still an active market. If we secure one more win next year, that would be a good outcome.
Thank you. And sorry, just one quick follow-up on IES. Just looking at the map you showed on slide 28 and remembering an MOU you signed earlier in the year in Kazakhstan, looking at a rather large number of mature fields. Is there any progress on that, and what sort of timing could we expect that to develop? Thanks.
Yeah, we signed the MOU, I think if I remember correctly, in July. So, the first phase of work has been about actually, the technical assessment of the opportunity. That work has been successful. We're coming to completion on that, and then it's really now entering a phase of a commercial conversation around the terms and how we would do it. So again, this is a very interesting application of the model. There's the ability to bring our services. It's not about booking the production and reserves. They remain with KMG, but clearly there's a big opportunity there in Kazakhstan to get more out of those fields. So, we're sort of, 5 months into the process, a lot of technical work done, and you should, be looking for something happening in, the next year, first half of next year.
Andrew.
Yeah, Andrew Dobbing here from JP Morgan. You've always said, expressed a wide range of margins in OEC depending on where the work is won. Can you give us an idea that 9%, what that's assuming in terms of where work is won between, I guess, now and the end of next year? Thank you.
Well, Andrew, we would like to have a mix in the portfolio where we are exposed to the same traditional markets we've been exposed to in the past. So it's a combination of business in the Gulf, business in North Africa, maybe Algeria, and business in the CIS. And we are targeting business in all these areas. So, Christian asked me about margin. I mean, we have to ensure that we have that mix in the portfolio. And we are working actively to maintain that mix. It's part of also maintaining presence in these markets, diversifying the portfolio, and also generating the mix of margin that we want to generate.
So, obviously, this year's been very exposed, order intake's been very exposed to Abu Dhabi. I guess it's at the lower end of the margin range, but you see opportunities for that to kind of shift back to markets like, North Africa and the Caspian to kind of help recover that profitability going forward?
Well, I mean, first of all, the business we have in Abu Dhabi, we're happy with the margin. It's not really, we're happy with the margin. We are very focused on operational delivery. But next year we have one particular opportunity that we have to convert, which we've signaled the KLPE project, which hopefully will happen sometime early second half. And then we've got, I talked about the bids in North Africa that we're pursuing, and we have some other things in the pipeline in these markets. So yes, we believe that we can maintain that mix in the portfolio. Thank you. Please, I'm going to go all the way. Yes, we'll have all the questions. Please, after you. Please, you. No, you ask a question, yeah.
Yeah, on the onshore, what was the initial sort of catalyst for partnering with the Koreans? And then how does it actually work in practice? Are there certain areas of the project where you think your differentiated margin applies more than others, and that's how you approach the JV? And then just on the offshore and the assumptions, just for modeling purposes, sorry about that, but the 15% capital employed refers to the billion investment, and that's safe to say that applies to the $2 billion revenue target in 2020?
Do you want to answer the question on?
On the issue of the joint venture, the basis for joint venturing in any of the joint ventures is basically where we have complementary resources and we have different skills that we join hands with. This is the basic aspect. And we have two models of joint venturing with the Koreans or other than Koreans. It's either a consortium where everybody is doing a vertical scope of work and he has his own margins, or same pocket, same money. The fact is that when we are doing same pocket, same money, we have the same level of margins, but we have a say in that margin, and we have never accepted to bid at the same level of our partners, the Koreans. We don't accept that, and we have basically, like the recent job in Oman, we have insisted on a certain level of margin, which is superior to any margin that we have in Abu Dhabi, basically, and we won the job on that. And when we are bidding in consortium, everybody is doing a vertical split to his own means. So the point is not driven by how you split the margin. It's driven by the fact of complementary resources and complementary skills and building track record for us, sometimes in certain areas where we have not built a track record, like the petrochemicals or something like the KLPE.
And then I guess then when it's same pocket, same money, is it safe to say Petrofac is leading the commercial side of that?
Yes. Yes, it's safe to say. Yeah.
Tim.
And Ryan, on the return for the vessel investment, I didn't say 15%, I said mid-teens IRRs. But it is on the vessel investment, including the benefit of the EPC work that comes from using the vessel. The whole of the $2 billion that Ayman referred to includes an expectation of the shallow water work as well. So it's not the entirety of the $2 billion will get you the IRR we're talking about on the vessel investment. You do have to include the deep water EPC work to get the maths to flow through.
I'm going to go there. You wanted, yes, please, yes. Can you press the button? Okay. Yeah.
Christine Tiscareno
Sure,
from
Christine.
SP Capital IQ. On the decommissioning, you've always been very interested, and the uncertainty that and dismantling of assets in the UK North Sea has dissipated. So I wanted to find, is your activity in that area contingent to the vessel being built? Or have you started to look at other things that you might be able to do? Is it going to be part of offshore, or is it going to be its own division? Could you just sort of enlighten us in terms of what you're going to do?
What we have right now, if you look at the business that we have in the UK, we're managing a number of mature assets. And the natural evolution of this mature assets business is to work on the decommissioning of these assets and the dismantlement or the deconstruction. We currently have a small business in OPO, reporting to Bill, which does the decommissioning management. So we work with clients, and it's more around mothballing, decommissioning, prepare for deconstruction. We do not have today the capability, because we don't have the gear to do the deconstruction. And frankly, we haven't had the risk appetite to be involved in the deconstruction, certainly not on a lump sum basis, because there's still a lot of definition that has to be made and a lot of understanding of the scope. But it is something that we see as an area where we will grow our competency and will grow our business. And we'll take the decommissioning management today to maybe a different model. And probably in a few years' time, we'll have the risk appetite, we'll be able to take on a deconstruction. We're not there yet. But certainly we see our evolution of managing mature assets ending up with the deconstruction and decommissioning. Now, having the lifting capacity helps, but I come back to the point that Mick said. We may be able to find cheaper lifting capacities for the work. It depends if it's in the southern North Sea, where you have lighter assets, versus the big stuff in the central and northern North Sea. So we have to wait to see what is the appropriate asset to be involved, to utilize for this deconstruction. Okay.
Thank you. Can I
Thank you.
just have a small follow-up question for Andy? IAS is self-financing by 2016, but do you think it will be a major contributor of positive free cash flow for Petrofac in that year or till 2018? Because you seem to be more successful than you had anticipated. You've got all these MOUs coming up, etc. So doesn't that imply that maybe you are going to have to invest more than you had envisioned in order to secure all those projects?
Yeah, it's a good question, Christina. Like, we clearly haven't made the capital allocation decisions for 2017 yet. So I think what the forecast actually incorporates is the new business that we plan to win through 2015 and the consequences of that. So as you think about the income target that we've set and then the consequences of following that through, that's what the cash flow forecast actually incorporates. Now, clearly, as we start to mature the plan over the next couple of years, as we get to 2015, we'll have options within the group as to where we allocate capital, and we'll obviously make those decisions on things that we believe will create the best long-term sustainability for the business, the best returns, etc. I think we're creating options for the future, and it's great to have a portfolio that's doing that.
Thank you.
Please.
Thanks. Phil Lindsay from HSBC. A couple of onshore questions, please. Firstly, I suppose, given a general slowdown in the wider market, are there any potential signs at this point that your Middle Eastern clients may again invest counter-cyclically, like we saw in 2009 and 10? And perhaps we can just explore the market opportunity beyond the 50 billion bidding number that you mentioned. That's the first question.
I mean, we believe the Middle East market is going to be quite active for at least the next year is very clear, and the 2015 market is starting to shape up very clearly. We believe the Middle Eastern market, particularly Saudi, Kuwait, and the UAE, they have detailed programs of development in the upstream and the downstream markets, which will lead to continuous spending in those in the next years. Some of those we are seeing them into 14, 15. Some of them we are expecting them to happen.
But I mean, if you go to Abu Dhabi, they have a very, very clear target, which is to build their production capacity to 3.5 million barrels a day. They have very clear objectives with regards to the gas production targets that they want to achieve. So, you know, a lot of these are long-term programs, and we have, as Marwan said, we have very good visibility on what they're going to be doing over the next few years, and I doubt very much that they'll change these plans. And Kuwait has a 2020 plan with regard to downstream, and Oman has similar plans. So all these countries are going to be very active.
Okay, thanks. Just a second question is on Turkmenistan. Just want to explore, I think you mentioned that you're hopeful of winning some work there next year. Are you able to elaborate on that? What kind of work is it? Is it follow-on work from South Yolatan, or is it other work that may or may not be competitively tendered?
There is competitive bidding that we have bid and submitted, and we are awaiting the results of those bidding at the moment, basically in South Yolatan. And there is a discussion on the follow-up work of Yolatan, but what I want to say here is that the first phase of South Yolatan, we worked on it for about 2.5 years, and we spent another 7-8 months doing a FEED before it materialized into a project. Those projects are real, but they are very slow. So South Yolatan, the follow-up work for South Yolatan might not happen next year. We are in discussion, it might happen later. But there are definitely a lot of activity in Turkmenistan that we are pursuing at the moment, and there are some bids that are normal bidding process that we are expecting results of.
Sorry, just one more if I could on the EIS division. Just thinking about the production enhancement contracts, it looks like the competitive environment has changed quite materially since you initially embarked on that strategy. So, in particular, it looks like there's a lot of IOCs actively looking and bidding in that market. I just wondered how happy you are bidding against those sort of clients, particularly given that your offshore strategy is targeting work with IOCs.
I think, Phil, we haven't actually seen any IOCs bid against us. So, you know, there was a I think there was some passing interest in Mexico, but none of them in the end actually bid. So, and I'd almost suggest there's a different dynamic going on as we look at Nigeria today. The IOCs are actually divesting assets there. They're divesting them to local companies. Those local companies need the services, and they're actually encouraging us to work with those companies. So, you know, I almost see the reverse dynamic. I don't see them actually stepping into that space. We haven't bid against anybody, and I actually see them doing the reverse at the moment, which is actually encouraging us to pursue the model so that they can execute their business model, which is to slim down their portfolios.
But I do want to emphasize the point. We're a service company, and we respond to the needs of our clients. So if an NOC asks us to bid a production enhancement contract, we will respond. Just as well, you know, we would respond to an IOC asking us to bid for an offshore EPIC project. So it's, you know, and our business is not around, I come back to the point, all we're doing in our business is we're trying to integrate the services that we have in our capability, and we're not driven by booking barrels or booking production. It's all around creating a model where we de-risk the delivery for our clients and hopefully generate higher margin from the capability that we have in our portfolio.
Thanks.
Please.
Neville Pike from Oxley. You, as a service company, a lot of your assets necessarily walk in through the door in the morning, sit down at a desk, and then go home in the evening. Can you talk a little bit more then about how you think of the availability of skilled labour and what is happening to availability and also maybe to inflation in that area?
It's a very, very good question. You're absolutely right. Our biggest asset is basically the human resource capital that we have inside the business. We have about just under 20,000 people inside the group. Look, I think first of all, in Petrofac we're a very international business, so we are hiring worldwide. We have 5,000-6,000 people here in the UK, but then the majority of our staff, about 12,000 to 14,000, are outside the UK. in the UK, the environment has been quite competitive for skills. The market in Aberdeen is probably as hot today as ever. We have a slightly different model with having more staff to contractor ratio than our competitors. We like to employ people because we have them as shareholders. They all have long-term benefits with the business. And at the end of the day, we still see some competition for resources. So if there is any high attrition we have in the portfolio, it's probably in that environment. But outside the UK, we have fantastic retention rate. It's below, it's around 5%, the attrition. I think the three things that you have to provide for people to stay is you have to, they have to buy into the strategy of what you're doing, and we have a very clear strategy what we're trying to do in terms of growing the portfolio. People know that they're coming and they're going to be growing with the business. The second thing is you have to have a very clear culture, so people want to know that they come into a business that cares about safety, cares about its code of conduct, and so on and so forth. And obviously then you have to be competitive with the compensation, and we are quite competitive with our compensation with the industry. But I think overall we have one of the lowest attrition rates in the industry. We have our own Petrofac Academy that takes a huge intake. We're up to this year, we're about 400 graduate engineers. 400 graduate engineers. We take them through the academy. We do the induction, we do the training. The first year it's all in-house training before we bring them in. We're increasing the number. Next year it's going to be 500. So, you know, this is our HR strategy is absolutely core to delivering everything we talked about. And the group HR director reports directly to me. He's a member of ExCom. It's something that we present to the board every time about the evolution of our HR. And, but I think we're doing very well in that space. Okay. I'm going to go there, please.
It's Jari Panya from Berenberg. I have two questions. One on your onshore. On the operational excellence slide that you presented, if you were to sort of backward calculate some of the best-in-class benchmarks in projects that you calculate, how much margin addition should we think? And also the data point you mentioned where you said that you're shifting workforce from Sharjah to India. What sort of margin benefit can we think from that exercise, basically?
I mean, first of all, calculating backwards is really the wrong thing to do, because basically what we are here saying is that this is a continuous improvement process. So you can't improve. First of all, you have achieved something, and then you try to beat that something. This is what you do. And that's what we are doing with operational excellence. So this calculation backwards is a bit fictitious, basically. To the second part of the question, I have indicated that we believe because of our operational excellence and the things that we are doing, we have 2 to 4% cost advantage. And that's why we can price and win business at a higher margins than the others.
And the second question is on the offshore strategy, or especially on the deep water offshore strategy. Just to understand, because if you're saying you want to spend $1 billion on a vessel, if I take 15-year depreciation, I get about $160,000 a day as just the capital cost, and add another $160,000, so roughly $300,000 a day of day rate. So just want to understand, are you saying you want to make money on the vessel and not going to sacrifice? Because I don't hear much of a talk with regards to engineering and procurement in that offshore strategy. So are you going to...
Well, I don't think, with due respect, you listened to the presentation. We said very clearly that we are not in the asset rental business. We're not going to sell it on day rates. The vessel itself is not $1 billion. The whole investment that we have over the 5 years is about $1 billion. The vessel itself, we're talking about $700 million. So we will have some room for specialist equipment that we cannot rent from the market, and that's part of our plan for 5 years. We are not going to make money by renting the vessel. We're going to make money by taking a $2 billion EPC contract where the installation in it is probably 300 million or 200 million or 400 million. And we then have a margin on the $2 billion. So when we reflect on the rate of return that we're generating, it's the profit we're making from the EPC. And the vessel, the installation, is an enabler. It's only to allow us to do the EPC. And I go back and I say, if I could rent tomorrow from Subsea 7 or from Saipem, I would rent from them. But I can't rent because they compete against us. And they are the ones who own these vessels. So, and the reason we invested in one vessel with a multi-capability is because we are focused on reducing the capital intensity of our business. We're reducing the capital spend of the business, and we're accessing a very wide market with a single asset. And all the other assets that we require, and I agree with you, we're going to require another 4 or 5 vessels. We know that they're available. They're available from people in West Africa. They're available from people in Southeast Asia. They're available from many people in the market. We'll partner with them and we'll deliver on these epic projects. But we are delivering epic projects. We're delivering EPC projects. Okay? Thank you. Please.
Hi, it's Caroline Hickson from UBS. I just wanted some clarification on some of the numbers you were giving in slide 19 in light of the recent IMS. You obviously said the net margins for 2014 around 11%, lower in 2015, but offset by revenue growth. It sounds like you're saying that 2015 overall earnings for the OEC would be flat on or 2014 or thereabouts.
This is what I'm saying. That's what we're saying. The growth in 2015, we're going to have growth in all the other businesses. We're going to have growth in the top line revenue, but we will have the margin dilution because of the Abu Dhabi business. We're going to have growth in all the other businesses in Ecom. We have growth in OPO. We have growth in ECS. And we're going to have growth in OCP business. And then we have significant growth ramp up in the IAS business. And this is exactly the point that Andy mentioned. The things that you have to watch in terms of growing the IAS business to get us to the number that we have to get us to the $300 million. But when we started, when we did the 2011, I mean, if you add the numbers, taking our number and add the growth in, you get close to where we said we will be in 2015. But obviously, we have lost the cushion because of the fact that we haven't sold in 11 and 12. So we have a very tight cushion. We're working hard to be there or thereabout for the 2015 targets. But the biggest chunk of the growth between 2014 and 2015 is coming from IAS. There will be growth in Ecom as a portfolio, but not OEC. Okay, thank you.
Okay, and is that the same as how you were feeling at the IMS, and that just wasn't sort of clarified?
No, I think it's exactly in line with what we said in the IMS. What we said in the IMS, I mean, what happened is, with us not having achieved 2011 and 12, we still were targeting to hit 2015. What happened in 2014 is that we had a shift in earnings on the Upper Zakum because of the redesign of capacity, and we had delay on the Barantai job. So now in 2015, we have that target, but frankly, we have a very, very tight cushion. And what we said in our IMS is we are still working on achieving our 2015 doubling of earnings. But this is very much dependent on the timing for the award of Ecom. We need the award to happen in the first half of 2014 because we need to be able not only to recognize revenue, but we need to recognize also income margin from these projects in 2015 to deliver on our 2015 net income target.
Okay, thanks.
Thanks very much.
That 9%, should we expect that to continue as long as you're doing the Abu Dhabi project?
That was the same question that Christian asked. Look, our portfolio right now, we have very good visibility on the portfolio that we have in hand, which is leading us to say to you very clearly, we have 2014, 11%, 2015, the dilution of 2%. We are targeting to achieve, we continue to achieve differentiated margin. We'd love to achieve better than 9%, but it all depends on the business mix that we have between now and the end of 2014.
Okay, thanks.
Please.
Hi, it's James Evans from Exane BNP. Question on IES. Obviously, we've got some great net income growth coming ahead of us, but what is the actual cash flow range that you're expecting from that business, Tim, if I could? Secondly, to Andy, do you think there's any value in looking at maybe disposing some of the equity stakes once you've added the value of actually developing it? So for something like Greater Stella, and just recycling that into your opportunities if you are capital constrained.
Yeah, on the first point about cash flow profile, we talked about the existing portfolio that IES has broadly achieving cash break even in 2015, and then including new investment prospects, the totality of IES achieving cash break even in 2016. On the basis we talked about an average of about $1 billion per year of CapEx over the next 5 years. That therefore means by the time you hit 2016, you're going to need EBITDA or operating cash to be about $1 billion for the overall portfolio to achieve cash break even.
Can I just make a comment on the second question, and maybe Andy then can say something. Look, we will have investments in the portfolio as long as we are continuing to add value by leveraging our core skills, period. We're not in it in order to add barrels of production or add reserves in the ground. And we will periodically visit our portfolio and see, are we going to continue to enhance the value from leveraging our skills or not? I can assure you that we'll be very disciplined. Whenever we get to the point where we believe we're not going to be adding value, we will have no issue at all of considering selling and recycling capital. We've done that in the past with EnQuest, with the demerger of EnQuest at the appropriate time. We created value. We also spun off a company that's now a leading UK player and it's doing very well. We will look at this. It's not currently in our immediate plan, but we'll obviously continue to look at the equity investments in our portfolio.
Yeah, no, look, I hope one of the messages we've given you today is about discipline, about capital coming into the business. You've equally got to be disciplined about the capital out, and we're doing that. So absolutely, I agree with Ayman. We're clear why we have those assets. We're clear if we can add value, that's great. If at some point we feel as though it's not achieving that aim, we'll look at other options. But it's all about the discipline of the capital employed.
But coming back to Stella, there are a number of other developments which are close by that could be tied back to the same. So it depends on our role there. Can we add value? Can we create value there or not? Please.
Yeah, hi, it's Alex Brooks at Canaccord. First question is on the risk profile of the cash flow, similar to James's question, which is you've said yourself you've got quite a tight cushion in terms of achieving where you want to get to in 2015 and 2016. But as your presentation also showed, the one thing we know about oil and gas projects is that they're subject to very high risk in execution. And clearly you've done an excellent job in managing the risks in the onshore portfolio over an extended period. But what comfort do we get that you can do the same thing in IES, which is a bunch of rather different risks, even if it's not reservoir and reserves?
Well, I said we're tight for 2015. We've never given guidance on 2016. We'll go back to hopefully growing again, but we said we're tight on our target for 2015 to be specific. Let me just say one word and I will then also hand over to Andy. The execution in the projects that we have, in most of the projects that we have in IES, we're leveraging the same skills and the same processes we have in Econ. So when we delivered Berenta in 21 months, the delivery of the offshore project was handed over to Marwan. Now, we've talked very specifically about the milestones that we have to hit in order to achieve our 2015 target. But Andy, maybe you want to say.
As you say, there's always risk associated with the delivery of these things. All I'd say is that, if you look at PM 3 or 4, we're actually making progress. West Ezra is now online. It's ramping up. It will probably exit the year at over 20,000 barrels a day gross. So you started the whole process there. The next stage is to get the FPSO. It's nearing completion, install middle of the year. Understand the reservoir. So you're starting to de-risk it because you're making progress on it. It isn't just like one big thing starting up. It's a series of steps. As you look at Greater Stella, we're not the operator. And the operator's making good progress on the drilling program, the subsea installation. we're making progress on the facility itself. So, there are, what I would say leading indicators that we're kind of headed in the right direction, and you need to monitor those milestones.
But we had a leadership conference just a month ago, and really what came out of the leadership conference is this my third or fourth slide about the value arbitrage that we want to capture. And really, as a business, this is where we see our future, honestly. This is where we see our future is all about operational excellence and proper delivery. You're absolutely correct. Are we consistent across the entire portfolio in the hundreds of projects we have? Of course not. But we do much, much better than many of our peers. And this culture of excellence in delivery, we want to drive it across the board. You're right, we have new people in some of our businesses, we have new staff in IES, but the focus of the executive management on the delivery and on maintaining this record is intense, and we intend to hopefully have the same success there as we've had in the onshore E&C.
Just secondly, I want to pick up on a point you made earlier about the biggest opportunity being in effectively the low margin that is made in offshore projects and operations at the moment. It's a low margin business and the outcomes aren't necessarily very good for the customers. Is that something which is part of this plan, or is that something which is a potential for the future?
Look, our offshore business and operations, the reimbursable part of the business, we have most of our margin through performance, through KPIs. And we would like to gear it increasingly to KPIs. But what I said earlier when we were having the reception is that the producers today, when you have a business which is time and material business, and the producers are under a huge amount of pressure to deliver to budget and to within time, there is a complete disconnect between the aspirations of the producers and where the service industry is. The service industry, most of it in Aberdeen today, is about churning man hours and maximizing the number of man hours, and then you try to, as much as possible to increase your margin. When in fact what you really want to do is minimize the man hours and minimize the cost and come up with an innovative answer and come up with a proper solution. So the discussions we're having with many of our clients is how can we be better aligned in our delivery with their objectives. And that means, some of our projects delivering them on EPC, maybe even taking the duty holdership model to a production enhancement contract where we take more responsibility and we get paid based on incentive, on increased performance. And we take responsibility for the reservoir. So the discussions that we're having with our clients right now, we have a listening ear today, which we did not have 4 or 5 years ago, when the market was very much about cost, and you are a service company, you're commoditized, just give us man hours and we'll do everything else because we're the old companies. Today, the dialogue that we're having is much more constructive, much more positive, and it's about creating a long-term alignment to achieve these objectives. So yes, we're having discussions, and hopefully we will be able to demonstrate it soon with some examples.
Thank you.
Thank you. Please.
Thanks. It's Fiona McLean from Merrill Lynch. I have a couple of questions really around clarification. The first one's for Andy. In IES, when you were talking about Mexico, you were talking about looking at new areas in one of the blocks. Can you confirm that's just appraisal versus new exploration? Because you've been against exploration in IES for the last 10 years or so. And then the second one is probably for Tim. About a year and a half ago, you set up this value creation plan that was going to be tied into you doubling your earnings. If you're not to achieve that target, does that mean there is no payout in the value creation plan? And follow on to that, you've talked a lot about the group's own profitability over the next couple of years, but you've had very little discussion about shareholder returns, whether it be buyback or dividends. So could we just get some thoughts on that as well, please?
Andy, do you want to answer the
first? Yeah, thank you for asking the question. No, it is not exploration. We have no capability to do exploration, and therefore we will never do exploration. Look, these are adjacent fault blocks. They actually sit next door to a producing zone. This is no different from drilling an infill well and targeting an unswept volume. It's that sort of mentality. So this is infill drilling. Calling it appraisal is probably a stretch.
If you don't mind, Tim, I'll answer the second question. Look, the VCP, I mean, first of all, the compensation for our executives, we have a bonus and we have a performance share plan. And both of these are based on delivery of the plan for the following year. The VCP was, the value creation plan was put in place if the stretch target of the organization, which is to deliver better than what we had said, is to be achieved. And that was, at that level, the PSP would fully pay out. So the PSP, the performance share plan, fully pays out on achieving the growth rate that we would have achieved over the 5-year period. So we wanted something over and above that. As it is right now, it's not going to pay out. I mean, it'll be, if we don't deliver, better than the doubling. But we have the other compensation metrics that we have inside the business, and they will continue, which is based on the yearly performance contracts that we have for every executive, including the one that I have with the board. On the, I mean, everything we said here also is based on 35% payout ratio for dividends, so we'll continue to pay dividend. And for the time being, we have many attractive opportunities to invest our capital, where we said that we will maintain a very high rate of return on capital employed throughout the business. When we get to a position where we don't have attractive opportunities in IES to invest, you know, our investment in the offshore capital projects is going to be limited over the 5-year period, strictly to what we said. But we see very attractive opportunities in IES. Should we not see them, we would be happy to return more money to the shareholders.
Okay, and maybe just another quick question. In onshore E&C, you're very proud of your track record of having never lost money on any of your projects. Are you able to say the same thing on your offshore portfolio?
Absolutely.
Yeah. Okay.
We've never lost money. Actually, we should say we've never lost money on any EPC contract. Now, we haven't generated in some place sometimes the margin, the bid out margin, but we've never lost money even on the offshore EPIC projects.
Okay, thanks.
Thank you. Please.
Thank you, Giacomo Romeo from Macquarie. 2 questions. The first one on offshore. Can you just remind us the phasing of the 1 billion capex? I assume that is going to be mostly back-end loaded, so shall we expect most of it coming once IES is cash flow neutral? And the second one on onshore. Given you discussed the 9% net income margin in 2015 being driven by the minorities impact, shall we expect, if we look at on the EBITDA lines, on an EBITDA margin, to be effectively flat year on year, so no change in the EBITDA margin?
Yeah, on the cash flow on the offshore vessel investment, you kind of need to split the vessel investment into 2 elements. First of all is the on-deck equipment, and then it's the hull itself. And broadly speaking, the spend is 50-50 between the 2. So if you're talking about, as Ayman said, about $700 million plus on the vessel itself, split that into 2, 350. The on-deck equipment is being effectively paid on a stage basis over the next 2 to 3 years, fairly even phasing. The investment in the hull itself, that is slightly more back-end loaded. So that second half is more weighted with a larger bullet payment in 2016.
And on the question on the EBITDA in the EPC business?
Yeah, it's a similar level of EBITDA and OEC from 14 into 15, so it's EBITDA and net income are broadly level between the 2 years.
Okay. Any other questions, please?
It's Radek Becker from Sumitomo. Just regarding your order intake for onshore projects, it's been a significant recovery in last year, and you mentioned that you invest heavily in the pre-bid stage. So what is the current success rate, and how does it compare to 2010 and 2009?
This year, I mean, we are about, we have been winning, depending on the metrics, how you look at it. By numbers of projects, it has been 1 of 4. By volume, is almost 1 out of 3, approximately. It's between that ratio. And the issue of 210 and 211, it was much lower. It was 1 of 6. And the reason for that is that we have maintained a very disciplined approach to our risk assessment and our margins requirements on the N211, 212. We've maintained it now. The behavior of the market has changed, so we have a better winning success rate.
Okay, so it's partly down to the higher investment and better preparation for the bidding stage.
The higher investment helps us basically to assess our costs much better and assess our risk much better and determine the risk level very well, and therefore basically, and it helps us in having an early startup, kick startup in the execution, which help the execution.
But our success is a combination of two things. I mean, we have continued to focus on this continuous improvement process, which continues to give us a cost advantage. So we built that, and we're saying that the competitive environment today is not as crazy as 11 and 12. We're seeing much better behavior from our peers. So it's a combination. I wouldn't say that it's only one of the two. But we feel now pretty confident that we can continue to be able to grow our backlog going into 2014.
Okay, thank you.
Thank you. Andrew.
Yeah, sorry, another question. You've always defended the turnkey business model relative to, I guess, the cost reimbursable business model of some of your UK peers. It looks like you're doing a little bit more kind of pure engineering work. Is that just to position yourself better on some of the EPC work that follows? And I guess relate a little bit to that, there has been some speculation in the press about interest from you in a large, I guess, US engineering company. Can you comment on that, please?
Well, on the second one, there is no process. We're not involved at all in anything. We did not participate in the formal process of what you're talking about, and we're not involved at all. On the first one, our engineering services business, Andrew, is I mean, two things. First of all, we need to have the engineering in order to deliver the EPC. In some markets, we like to go in and provide just engineering services before we do EPC because it's a lower risk business. And it's a way also to maintain presence in some locations for the long term without having to incur the overhead. So if we had a contract in a market where we have a 3 or 4 years EPCM, I mean, for instance, let's take the project we have in Mexico. It's a great way for us to establish an offshore deepwater engineering capability in Mexico before we embark on doing EPIC business, because we are managing for Pemex now the supply chain. We're doing all this on a reimbursable basis. So it's an excellent way before we get in and do an EPIC in Mexico. But hopefully the next stage, I mean, we're talking now about another reimbursable engineering job, but the next stage is when they are ready for some of these things to be done on EPIC, we would have had a lot more knowledge to execute these projects than many of our competitors. So we're not in the business of building a Jacobs or of hundreds of people just selling engineering services, but it's absolutely core to everything we're doing, having the ability to deliver engineering on a reimbursable service to help us, establish the capability and de-risk our execution for EPIC.
So one more question, maybe for Andy. When you look at the opportunities in IES, is most of that still competitively bid, or is there quite a lot of negotiated contracts? And if there are a lot of negotiated contracts, are you turning down a lot of work because it doesn't reach the financial returns you require or you seek?
You know, it's a mix, Andrew. Yeah, you know, some of it's bid. You know, Mexico's been typically an example of that. When you look at what we're doing currently in Kazakhstan, you know, it's a process of pre-qualification established in the MOU that allows you to do the technical work. And then, as you say, we have to go through a commercial process to make sure we're getting quality returns. A lot of the stuff we knock out early in the stage of almost a pre-qualification, whether we believe, you know, we can make a decent return. So that's kind of where the process falls out. But I think the nature of it is you're going to see both things going forward. You are going to see things that are are more akin to the Mexico type bidding process. And then you'll see others, where it is about, us being pre-qualified to provide a service, and then it's coming to a credible business model that makes sense. And I think Kazakhstan would be an example of that. So you see both.
Christian.
Just two follow-up questions, please. First, you mentioned sort of a couple of years ago, or in retrospect, you'd understated the extent to which Koreans would be aggressive in pricing. What makes you, or what gives you the confidence that they won't come back with a vengeance? Particularly given when you talk to the Koreans, they seem to be still very revenue focused. And secondly, there's clearly sort of a range of margin within the portfolio in onshore. Which regions should we be looking for to support the higher end of that range? GCC is arguably a lower end. What are the regions we should be looking for at the higher end in awards?
Well, look, I'm not going to be able to control what the Koreans do. They're going to do what they're going to do. But I can tell you from what we've seen in their bidding, and we are in joint ventures with many of them, and we were actually visiting our joint venture partners in Korea 6 weeks ago. They've announced, many of them, they've announced huge losses that have wiped a big part of their equity on their balance sheet. B, we've seen changes in the leadership of many of these competitors. And actually what we've heard from them is they're focused on profit and no longer volume. And we've seen their behavior change with at least with the, we're experiencing from the bids that we're participating in. Now, if they change their behavior later on, there's nothing we can do about it. But all we can do internally is continue to ensure that we are very competitive, we're extremely efficient, and we maintain our discipline. That's what we're doing. And we're trying to build a bigger portfolio in the business by going into IES, by doing the offshore epics, in order not to reduce the volatility that we have in the business to the onshore E&C. And looking beyond 2015, our onshore E&C becomes less than 50% of our business. It goes down to about 30 or 40%. So that's all we can do, and that's what we focused on. The second question you had was about the
countries. Actually, on the countries, Christian, some of the GCC countries have higher margins than other countries. And you have countries, what we are aspiring is that, as we said, Algeria, we are aspiring for some business in Algeria. We are aspiring for some business in the CIS markets, but also we are aspiring for higher margin business in some of the GCC countries, basically. And we are selectively looking at Asia and Sub-Saharan Africa, where there are some projects where we think that will attract higher margins.
I mean, we were not the low bidders on the last project we announced in Oman on the Sahara refinery. We were the third low bidders. And so, we did not get it because we burned our price.
The first bidder got disqualified, but we got it over the second bidder, who was lower than us. We were still awarded the job, and we did not burn our price.
And would the higher margin business be consistent with, say, for example, Turkmenistan, sort of close to 15%, or what does higher margin mean? If you don't want to say, fine. But
look, I think we would be very happy if we achieve double-digit margin in any business. That would be higher margin. Anything above the 9% is higher margin business.
Thank you.
Thank you. Please. And then I'll come back.
Thank you. Hi, this is Assis Farid from Berenberg. I have two questions for you. It's basically on the offshore side. You have been talking about the Bonga Power project for which you have qualified, which is quite good in my view. Just want to ask you, what kind of other opportunities do you see in the near term for the offshore side for which you might be bidding for? Any interesting opportunities which you are seeing? And secondly, considering like you are building a very complicated boat, that is very clear from the specifications. We have seen what has happened to Saipem, what has happened to Technip when they rolled out their boat. This boat which you are building is going to start installation phase in 2017. Isn't it a bit risky bidding for projects if there's any delay in the delivery of the ship? Thank you.
That's a very good question. Eve, do you want to answer these two questions on what other prospects we're seeing and the?
I think we are evolving from a situation in which the prospects are few because of a lack of a vessel or enabling vessel, in a situation in which we will have to select. I mean, we will not be able to bid all the projects on which we will be pre-qualified. So, however, it was a very good step that we got pre-qualified on one of the biggest EPCI turnkey deepwater projects. Even before, just at the beginning, we were expecting to start bidding this next year at the earliest. So the opportunities will be wide. We need to concentrate. So we said that we will be starting from areas in which we feel more comfortable, like West Africa, Mexico, that we highlighted. Of course, Golden Triangle in a wider range, which is Southern Atlantic, where 70% of the deepwater development are made. But we will be selective. And we also said that in our business plan, we have included a prudent EPC factor. So project like the one we mentioned, just as an example, has very high EPC factor, kind of 20 times more of EPC compared to the installation services of the main vessel. But in our business plan, we have been prudent, and we started with kind of 5 times, which is typically more, much less complex type of works. So there are plenty of opportunities.
And I think the risk, the point about the risk with the delivery, maybe you want to address it because we're building a complicated vessel.
Yeah, I mean, the project that we are targeting will not be, will keep afloat, but we are not having that, we don't perceive that as a major risk because we are not targeting a project before the vessel is delivered.
Also, your building model is very different. You de-risk it.
Sorry?
The building model for the vessel, the way we are approaching the vessel.
Yeah. Oh yeah, sure. And I mean, as this was also explained by Ayman, I mean, when you look at vessel delivery in the past, you see that major equipment have been a big hurdle and have had delays. They are the most complex item of the ship. And with this, we have started since July securing and starting engineering procurement on those.
And we have spent the last year detailing the engineering to the point where we have absolutely, we know every nut and bolt. So we're getting it defined to bits so that we're managing all the interfaces, and we're going to have a big project management team. Kimon here with us. We have a big project management team sitting on this. And obviously when we bid, we're going to allow for adequate float so that we manage that risk adequately.
Thank you, very clear. Just one follow-up question for Marwan Shadid. You were talking about the OPO division, and you were talking about the evolving duty holder contract structure. Are there any legislative changes in the UK part of the North Sea on the duty holder structure that we should be aware of? And secondly, what kind of competitive environment do you see on the UK part of the North Sea for the OPO business? Because we do see your competitors such as Archer Solution talking quite aggressively about entering the market. They are already bidding for a number of contracts over there.
When we talked about evolving the duty holder, it's basically talking about how we can take the duty holder from a duty holder and move it down to a production enhancement contract. That's what we are, and that's something, it's not about what they're changing in the legislative system or something. That's the point that we were making. As far as the competitive market, the model that we are, our commercial model, where we are not selling only man hours and getting compensated on commoditized market, where we can offer our clients a commercial model where we are paid some as part directly as direct man hour, and the rest and mostly our profit is through KPIs and production enhancement and uptime of the operations. I don't think the competitors that you are talking about are in that range as well. So that's why we think we have an advantage over that, and we can attract a little bit of a higher margin. And that's what we have been doing in the North Sea.
But there is no doubt that the market in the UK is healthy, it's hot, there's a lot of money being spent, but it's a competitive market. It's an open market. You know, we have 2 or 3 formidable competitors here, and we have people like Aker who are coming from Norway. So, but this is why we're focused on being paid, on international expansion, and what we're doing in the UK, we're focused much more on incentivized type contracts and on taking our contract model further.
Thank you very much. Very clear.
Any other questions, please? No, it's you.
Yes, Dave Thomas from Credit Suisse. Eamon, you're very, I think, animated about the vessel and the investment being made there. You seem very passionate about it. But when you're talking to your shareholders, I know you're a major shareholder, but when you're talking to your major shareholders, what is their feedback to you about it? How do you get that passion across to them? And in particular, I think there's a couple of areas you may not have covered so far, which are things like the accusation that you'll just have the one enabling vessel. You can obviously contract in others, but just one vessel doesn't make a fleet, for example, compared with your competitors. And also, it could present scheduling problems on a number of contracts being undergone in the same year. What happens if there's delays from one to the other? So how do you counter those sort of accusations? Thanks.
Well, look, I think the shareholders' concerns are some things that we obviously take into consideration. But really, the concerns of our shareholders are based on what they see in the market with others. So, they see that Saipem says something, or Aker has or Subsea 7 has an issue with a contract. Then they look at the read across to our business. I'm not saying that we're not impacted by what happens in the market, but our business in the offshore is very different from our competitors. We're not looking, I repeat, we're not looking at building a very big fleet. And what we're trying to do is have the access to the widest possible market with the minimum amount of investment in an asset. And this is why we have the multifunctions. By having this high-end market, we can then talk to the second-tier companies who provide us with the lower capacity installation vessels. And on all the jobs, including Bonga, we have partnered with others, exactly the same we would partner with construction contractors. For me, if you look at it as a CEO for the business, we have the ability to be in the shallow water. We've had 10 years of track record on offshore EPIC business. The market in the deep water is growing at a faster rate, and it's a healthier market with the margins. So how do we go there? I mean, this was the question for us. How do we go there? And I said in my presentation, if we were able to go by leveraging third-party assets, we would have done that very happily, but we couldn't. So we said, if we're going to go there and address this wide market, we can do it by building 3 vessels and spending $1.5 billion or $2 billion, or by doing it in one asset, which will have all these capability. The point that you're talking about, we obviously have to schedule it adequately. You're absolutely correct. The problem with if you look at the application of this vessel on any particular application, it is probably not optimum because it's more expensive and it has a lot more bells and whistles in it for that particular application. But we'll more than make up for it by the fact that most of our competitors have 50% idle time for their fleet. So we're going to have a higher utilization for this asset. And in the process, we're going to be able to maintain competitiveness for this vessel in the installation. But believe me, we've had a year of discussion on this very issue and the board about where do we go, how do we access this market? And this decision was not made lightly. It wasn't, Ayman Asfari deciding to build a big boat and having it. And actually our board, no, seriously, and our board wanted, for the first time, they wanted to retain third-party consultants to question the management and to test us on this. And we've had 3 long discussions and debate about how do we enter that market with this. So I feel that we've exhausted the discussions. We are going to bring our asset to the market at a time when we feel that there is going to be a very big growth in the deep water capacity. And I don't think, for us, when we talk about the $2 billion business, it's about probably 1.2, 1.3 in the deep water and about $700-800 million in the shallow water. It's not going to be, it's not a very ambitious target. We're not going to be a Subsea 7 but we will generate in that business a differentiated margin, and it's part of the evolution of the business going forward. It's part of the overall growth.
I think the question is basically on the scheduling. This is addressed in the business plan by not having a high ratio in the business plan of EPC to vessel installation. That means we have a little bit flexibility of how we schedule our vessel from one project to the other.
But I want to repeat that with our competitors, the vessels that are at this high end, they also do not have too many. So, you know, that's at this high end, most of our competitors, they have one asset. So that is a challenge that they also face. But obviously, they have a fleet of lower capacity installation vessels. Please.
Yes, two questions, if I may. James Hutton Mills from BNP. Just on the 9% margin again, just to be crystal clear. If you were to strip out the Abu Dhabi JV, does that mean that the underlying margin would still be 11%? And then secondly...
It would be between 10 and 11%.
It would be between 10 and 11. Okay, that's very helpful. And then secondly, there are those in the market who feel that the IES business ought to be on a lower multiple than the rest of the business. What do you feel is the best way to fully realize the value of IES over the medium term? Is it to potentially IPO it? Is it to sell off some of the investments? Or is it such a core part of the business? Is it the future of Petrofac that it's not even contemplated?
Well, look, we could not build IES without Econ. It's as simple as that. So this is not about an investment business out of air. It's about leveraging the skills that we have in Econ in order to build a differentiated business. And the synergy between the two businesses are very, very strong, particularly with the offshore business and particularly with OPO, with the ops and maintenance. All the transitions that we have had in Mexico when we took over or in Romania, they were with the help of Bill's business. And the operations we have on the floaters that we have is also with the assistance of OPO. So there is a huge amount of synergy between the two. And the issue is that IES cannot, IES cannot build this portfolio of capability and keep it occupied at all times. You have to have third-party clients to maintain this capability. And even with some of the subsurface skills that we have, for instance, with the drilling management, we have how many drilling engineers? 200?
No, about 150.
150.
Across all the disciplines.
Across the disciplines. A lot of them are working for IES, and some of them are working outside. But when IES needs them, they have the core skills that they can call on. Now, on the, are we frustrated that I think the market should give us a multiple? This is a long-term service business. If you look at the Mexico business, these are 25, 30-year contracts. We have, you know, we're going to continue to generate earnings from these for many, many years to come. I think what the market is not appreciating that we have the optionality in that portfolio to continue to create value from looking at developing more and more of these assets. Andy spoke in his presentation that all we're developing from the Chendor Phase 2 and West Desert, 122 million barrels for more than 1 billion barrel in place. That's probably a third of the developable reserve. So we have a lot more developments to do in that portfolio to capture value. And I don't know, I mean...
I think, we can have a long debate about valuation methods. I just want to leave you with one message, particularly as you look at the PET contracts. 25, 30-year contracts. These are very big resource bases. We're not exploring, but what we are going to do is fully develop that resource base over the 25, 30 years that we have it. All I'd say is in the first year and a half of looking at them, the example being Santuario, we've actually created a very credible long-term income flow from that field. And I think, that's the question really, is if you think of something that has multiple years of income and cash coming from it, how would you value it? I'll leave the challenge with you. But, I think this is a very secure piece of future earnings.
Exactly. Please.
Just one follow-up on the offshore business. You've talked obviously extensively about the vessel. Could you give us a little bit more color about some of the other parts of the business which you think are key, where there are sort of gaps or scope for you to develop further, like procurement, engineering side, or are you already there in those areas?
We've done a gap analysis of all the skills that we need to add to the business, and we are more than halfway through with more than halfway, probably 60 or 70% through with bringing the technical resources to the group to add to that. So, I mean, we have with us...
I mean, on the procurement and the contract management and the risk management, those are actually core capabilities that we have in the business already, and that's something that we don't have to recruit and develop. This is within the business. We have identified certain engineering capabilities that are missing, in particular for the deep water offshore, basically subsea engineering, etc., where we have already developed some capability through acquiring KW and RNZ already, and we have identified some project management and some engineering and installation management, which we are hiring at the we are recruiting at the moment, and we have a good ability to attract good talent in the market. I think by the time we start bidding the deep water offshore projects, we will be there through that, what the basic capability that we need.
Exactly. Any other questions? Thank you very much. Thanks. We have drinks being served next door, and we look forward to having some more discussion in the breakout session. Thank you so much.